Hey, so we're looking at acquiring a business with a client and is basically an electrical distributor. And I'm going to go for some key indicators. I'm going to go from some key concepts as far as analysis today. So hopefully this kind of gives you some context on what it is to go out there and buy a company. So first of all, we're looking at 2022, 2023, 24 and 25 high level numbers. We're looking at revenue, we're looking at gross profit and adjusted EBITDA. So first of all, the business is going from 14, 17, 22, and it's been sitting at 22 also in 2025 as far as 22 million of revenue. The gross profit it's gone from 3 million to 4.8 million, and then the adjusted EBITDA went from half a million EBITDA to close to 1.7 million EBITDA. So those are the kind of key indicators of a deal. It is basically an electrical distributor that is selling to electric power utility companies, telecom providers, marine sector companies, industrial firms, things like that. So it's large scale commercial industrial work that's being done with some of these products. I guess the business concept, the business model is fairly simple. They're a logistics operator in between manufacturers and then these businesses. So they sell to these businesses. And what they really do, what the value here is of this business model is they provide speed and availability because they have a inventory, they have a relationships, and they have a fulfillment. That's where the value is. Now, what's interesting is because these are businesses, they can be considered as recurring customers, and because it's tied to infrastructure, construction, utility, maintenance stuff, it is a fairly recurring business model. What's interesting is this business basically has been growing till 2025 right now, last 3 years, and the gross margin is fairly stable, 21%. The EBITDA margin is in between. It started at 3.5 and it actually grew to 7.7, which is almost tripling in 3 years, right? So that's a big positive related to we looking into the deal. Now, if we're looking at raw valuation, the value is going to get pushed up or pushed down depending on a few very important elements within the deal. Number one, the value is going to be up if there's going to be less concentration risk. So if we see a customer that has a little bit more than 15-20% of the whole revenue and the whole profitability, that is going to push down the value significantly. So it's going to go from a medium tier value proposition to a lower value on this deal. We want to look into carefully the organizational chart of the deal, and we're going to get some basic information on the management team. And a deal like this should have better systems and better people in place that are not just the owner operating everything. And in that case, if we kind of get to confirm that, then that value is going to be pushed up if we can find that out. Another value add here is going to be relationships with a lot of these customers for how long they've been around, and that is going to increase the value, right? If we're looking at construction exposure in just one metro area, that could potentially push the value down. And then if the owner is doing all the sales and the other people are taking care of operations, that's also going to push the value down because we want to make sure we have a sales team and a sales process in the company. The value is going to get pushed down also if we can get to notice a lot of accounts receivables, weak accounts receivable controls, and aging accounts receivables. So those are going to be the main things that are going to essentially mitigate the multiple in between 4.5x to maybe 5.25x. So depending on what we're going to find in the business as far as some of these key elements, we're going to attach a multiple on that net profit, on that adjusted EBITDA. As far as feasibility for an SBA 7A, well, this is going to get tricky because the enterprise value might go a little bit above $8 million. It might be close to 8.2 and we're going to need to kind of think on how we're going to be able to do the deal with an SBA 7A loan. And one of our partners essentially gave us the recommendation to do the loan in a very particular way. So you can always do deals above 5 million, by the way, with SBA, but they need to be structured in a different way. So there's a structure called 5-2-1 type loan, which essentially is 5 million in SBA lending, 2 million in seller financing, and 1 million in down payment, or some sort of variation of this. That's if the deal goes up to 8 million. If a deal goes above 8 million, then it becomes a little bit trickier. At this point, we're going to need to look at a higher seller note, a little bit of a bigger down payment, or lending above a 5 million cap for conventional lending or reduced guarantee SBA lending. So at that point, the deal has to be very strong from a price point, from a cash flow perspective, and I think it is. And we can probably get it done with some of our partners that we have in the ecosystem. And now, how are we going to position the deal as far as getting more equity? Because one of our clients that is getting into the deal, he's probably going to need to get some additional equity in the deal to have at $1 million down payment, or to have at maybe a little bit even more capital. So the way we're going to position the deal is we're going to make sure we show cash flow stability. We're going to make sure we show the fact that the contractors or the businesses we're selling to, they're rewarding on a monthly basis, and that we're able to keep the businesses interested into buying from us. And that we're also going to show the margin expansion from 3.5% to 7.7%, and that we're going to tighten up purchasing, inventory. We're going to tighten up essentially the whole process related to improving inventory turns, right? If we can show that to investors or even any lending, we're going to be able to get more buy-in. We also want to make sure that in a deal like this, we do what's called, we're going to keep as much cash in the deal as possible, right? So we're not going to be in a situation where we're going to try to get as much capital as possible from the lending side, but we're going to actually do it in a way in negotiations with a seller that we can keep as much capital in the business before we get capital from lenders as working capital. So we're going to be super conservative on that process, and we're going to negotiate extremely hard to be able to show a signal to the market that we have that already in-house. Yeah, we're probably going to need to keep the seller financing on a standby note for at least 2 years as well, to just delay the payment a little bit later. And we're going to be in a situation where we save as much cash as possible for, one, the lending component, and two, the return of capital we're going to deliver to these investors. Most likely we'll have a few other co-investors in the deal, just because the down payment is a little bit higher. It's over 1 million, maybe 1.2 million in the end. And our client is going to put way less than that in the deal. We're not going to use all our client's liquidity. We want to de-risk the deal for him. So that way we're going to go and raise a little bit more equity from the ecosystem we have to be able to close this deal. So hopefully this gives you some context on the deal we're working on and what we're working on right now to close some of these deals. If you're looking to do deals in between maybe even $500,000 EBITDA up to $3 million EBITDA, and you want to get a lot of support on finding them, analyzing them, making offers, renegotiating some of these offers, having partners that can help you with lending, having partners that can help you with co-investing, bringing in accountants, lawyers on the deal, doing quality of earnings, understanding how that works A to Z, then reach out to me. I'm happy to look into everything you're doing and help you with the process. Thanks.